Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. Equities have rallied more than 10% over the past 2 months, pulling the asset class out of a bear market territory. This has left investors wondering if the worst is behind and if this is the start of a new bull market regime. Before we consider the outlook, let us see what has been driving the market performances so far this year. MSCI All Country World Index, a benchmark index of global equities, lost circa 23% between the start of the year and mid-June as markets feared that persistent inflation will force the central banks around the world to pursue a hawkish monetary policy that would in turn push the global economy into a recession and cause corporate profits to fall sharply. As a result, investor sentiment hit a bearish extreme around mid-June. However, since June 17th, equities rallied by circa 11%, cutting the year-to-date losses on the asset class to just 14%. In the US, rally in the S&P 500 index over the last 2 months was even stronger. A 15% rise in the S&P 500 index since mid-June has cut the year-to-date losses on the index to just about 11%. Indeed, based on the performance so far in August, S&P 500 index is set to record its second best summer since 1970. The only time in the last 52 years when US equities fared better was 2020, the summer of which saw a strong rebound in equities following the sharpest bear market on record. Behind the recent rally in equities is a change in the market assessment of the drivers. Most importantly, markets started to believe that the developed world central banks will unlikely be as hawkish as initially expected. In fact, Fed funds futures indicate that the US Fed might be cutting policy rates in early 2023 as inflation starts to cool substantially and the growth slows. Adding to this, markets seem to now believe that a recession, if one materializes, will likely be short and shallow. Further, Q2 corporate earnings season was stronger than expected, alleviating fears of a sharp plunge in corporate profits. As such, over the last few weeks, we've seen a revival in investor sentiment and the hedge funds have started to unwind their hawkish and bearish bets, allowing equities to enjoy a relief rally. Now the question is, how durable is this summer rally? The strong performance of recent weeks after a very weak first half of the year indicates that markets have priced out, at least in part, the worst case scenario which they embraced earlier this year. While we do believe that the worst of the performance in equities is largely behind us, we do expect volatility to take hold over the next couple of months. After all, perceptions about the market drivers could change once again and markets could reconsider the worst case scenario. This would mean markets once again worry about persistent inflation, hawkish monetary policy, and economic and corporate profit recessions. Add to this a range of political and geopolitical risks on the horizon over the next couple of months, drivers of volatility become clear. By the by, if you're interested in knowing how investors should account for political risk, please listen to our recent podcast titled Political Risk and Financial Markets. In summary, while we remain optimistic about the outlook for equities over a 12-month time frame, we think further near-term volatility cannot be ruled out. Especially against the backdrop of a technically overbought equity market and existing uncertainty around the macro outcomes, complacency might prove to be costly. Therefore, we think investors should remain disciplined and diversified in their investment strategies and wait for an appropriate time to re-risk fully. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information on what was discussed on this podcast and to understand how your portfolios are positioned for the current market environment, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com for more information. My name is Kishore Muktinutalapati, and I'll be back next week with more global investment insights.